Let's talk business. And the Kenya Bankers Association, the umbrella body for all commercial banks, is warning of lower credit extension to the private sector should the Central Bank of Kenya insist on its proposed risk-based credit pricing model, which they say risks stifling access to credit for vulnerable enterprises. The bankers have further described the proposal from the regulator as a reintroduction of regulatory control over lending rates.
The banking sector is up in arms in opposition to a risk-based pricing model proposed by the central bank. According to the lenders, the CBK proposal, which has the central bank rate as the base lending rate, also proposes to introduce a risk premium K, comprising the bank's operating cost of lending, a return to shareholders, and the borrower's risk premium, which shall be reviewed by the CBK. An issue that the lenders body now says is equivalent to an indirect interest rate cap. This, they say, will result in a reduction in lending to Kenyans and businesses, especially SMEs, as experienced between 2016 and 2019, when the interest rate capping law was in place.
Banks go to CBK for approval of both the base and the K. And the oral conversation was, don't go past this. That's also the challenge that is there within the market here. So there's a control which is verbal, and being a regulator as an individual bank, you can't do anything. That's the direction we are taking, where we are saying this K come as an individual bank. Oral instructions will be given. This K ought to be at this level. Don't go past this level here. So for us, by all intents and purposes, the way the proposal has been made, that's interest rate capping, which will not be known to the public. Unfortunately, that capping will be worse than what we were in 2016-2019.
Bankers Association also argues that a flexible and transparent model where premiums reflect differentiated borrowers' risk and prevailing market condition is consistent with Kenya's liberalized interest rate regime, adding that disregarding the interbank market weakens monetary policy effectiveness and misaligns market outcomes. Bankers argue that a formula alone can't lower the cost of credit and that more attention should be paid to the fundamentals.
Each and every bank, they tried to be able to come up with a format that will work, but even presently, the formats that were approved by central bank are not being applied by banks, because if banks apply the current risk-based pricing framework, the interest rate is going up, even when the CBR is coming down. So that's the trouble that we are in currently. That's why we're saying this risk-based framework is not working.
And as the push and pull between banks and their regulator continues, it is the consumers who will have to bear the cost of high credit or the cost of not being able to access credit, even as they wait for a lasting solution to be found. Jimmy Mbogo, Citizen TV, Nairobi.